I spent the weekend with a lot of investors, hedge fund guys. I was assuming that they would be very concerned and biting their nails, but actually they expressed a lot of relief that finally there was some volatility. That meant they were going to be making more money. Is this perhaps a healthy wake-up call?
Hang on a second. This is your idea of a fun weekend?
At least I wasn't going to a wedding.
Yeah.
Is it a healthy wake-up call?
Well, I think that what's really happening is that things have changed in markets. Investors were probably too optimistic and a little too complacent for the first 9 months of this year. Going into mid-September, we had low volatility, low interest rates, low inflation, expectations of moderate growth, S&P up 10%. Everything was, the stock market was telling you that things were great. Meanwhile, the bond markets were telling you that things were not so good. European yields at record lows, 500-year lows in European yields. And what's happened? I think that investors have started paying attention to the bond market. You've started seeing a re-rating of growth and the reintroduction of a tail risk of potentially deflation into markets.
Yeah, I would agree with that. But I think also what the markets got caught off guard about was probably the lack of potentially an effective strategy by the ECB. So inflation expectations were falling in Europe, yields were falling in Europe, sovereign bond yields were falling in Europe, and then Mario Draghi comes out and announced this asset purchase program, probably below people's expectations. The takedown for the RTOs was lower than people's expectations. So I think the market's kind of saying we need more. We need more action by the ECB. And on top of that, you've got potentially the Fed moving towards a rate hike, which has been offset over the past week by comments from Fisher and Dudley, et cetera. But I think a lot of that was just, high expectations for growth in the U.S., a bit of complacency, and then a little bit of disappointment from central bankers.
That does raise some questions about how the Fed needs to act in the weeks and months ahead. Why don't we listen to Stanley Fisher, who was quoted over the weekend?
The stronger U.S. economy should directly benefit our foreign trading partners by raising the demand for their exports, and perhaps also indirectly by boosting confidence globally. And if foreign growth is weaker than anticipated, the consequences for the U.S. economy could lead the Fed to remove accommodation more slowly than otherwise.
So the Fed vice chairman there talking about how the central bank views the importance of the international economy, not so much the pace of domestic growth. How surprising is what Stanley Fisher said, or not at all?
Well, I think it's consistent with this kind of reassessment of the global economic position. I think that the rising dollar, weakening growth in Europe, Japan, some concerns in China give the Fed cover to remain lower for longer.
Do you think we'll end up having to delay the rate hike?
Well, we're not forecasting that they delay it. We're still thinking mid 2015, but it definitely removes some of the concerns about an early reduction.
Here's what I don't understand though. In every time, it seems, or almost every time over the past several months, when it seemed as though the Fed had reason to stay lower for longer, the market rallied.
Yeah.
And that's not what's happening now.
Yeah.
Well, I think plenty of other issues going on, right? You've got some idiosyncratic risks, Ebola, ISIS, et cetera, really weak growth in Europe. What do? One of our chief economists, Joachim Fels, has been talking about the Japanification of Europe. And the ECB really has to do more. Mario Draghi got away with basically spending zero, right? Neutralizing or, basically spending money but then taking out of the market.
Problem is talk is cheap, right?
Talk is very cheap, and the market was disappointed when he finally did step up and decide to spend money. And I think what the Fed is saying now is that the dollar, the stronger dollar, is actually doing the job for them, right? It's slowing the economy down. It's deflationary. We're importing deflation from Europe and Japan. So I think if they can come out and say this probably delays the next rate hike, they won't give us a specific time frame, but we don't actually expect them to hike rates until the first quarter of 2016. The market was pricing in mid next year, and you're starting to see that pushed out in Fed funds futures now.
Yeah. Ironically, Japan may actually be ahead of Europe now, as they have been more aggressive on the monetary front. They are seeing signs of improved kind of price movement, and the Abe-san has the strong political support to continue on the path he's on. A lot is going to be learned in the next couple of months as they look at kind of economic results to see if they can continue on their path of reform.
They just now have to digest that consumption tax, and another hike on the consumption tax is coming. So Abe's got his three arrows. What do you think Mario Draghi's next move is? Obviously, you're overweight European equity. equities despite the fundamental deterioration of the European economy.
Yeah. We are.
Which still makes everyone scratch their heads.
So there's a couple of catalysts coming up. You've got a European summit meeting, so the governing council will get together. I think there's going to be an impetus. Usually crises create responses from policymakers. I wouldn't describe it quite as a crisis yet, but we're getting there, so they may actually react to this. Do something on the fiscal side combined with monetary policy. You've also got the AQRs for the banks. The stress test coming up. They'll have to recapitalize some of the banks. Recapitalizing the banks sets a higher target capital ratio. So the banks may actually have to lend more. Credit growth is really what's slowing Europe down. So a combination of monetary fiscal policy combined with doing the bank stress test may actually get the ball rolling. I'm not suggesting it's going to be gangbusters growth anytime soon, but just getting it moving in the right direction, I think.
I mean, that all makes sense, but we've been hearing that for many years. Yeah. Why is it going to be different now?
Look, I think a lot of people have talked about what inning are we in the U.S., and we did things fairly quickly. The Fed basically made the banks recapitalize, did stress tests, made them recapitalize. Lots of fiscal policy, lots of monetary policy. Europe's basically been delaying it, right? You've got a diverse region over there, different fiscal policies versus monetary policy. So we've been saying Europe's probably in the second or third inning. I would agree with Eric, though. I think Japan might have leapt ahead. A 20-year rain delay is finally starting to let them get back on the field and start playing, and maybe the rains are coming in Europe, and they're going to be delayed again.
Before we wrap it up, can I just bring up a chart that's got a lot of people scratching their heads? It's a U.S. stock chart, and it shows that the large... No, this is not the one. We'll bring it up in a second, but it's
that's also a head scratcher, though. How is Spanish government debt?
This is true. So here we go, right? We have the S&P 500 in white, we have the Russell 2000 in yellow, and in the middle we have the S&P Mid-Cap Index. How is it that the multinationals, right, the largest corporations in America with the most exposure to the malaise in Europe, presumably Japan as well, and all of the problems that we see in emerging markets, are outperforming the companies that are, by definition, more domestic?
Yeah. Well, they've been able to take advantage of growth in the emerging markets up until recently. They've had the ability to borrow at much lower rates. They've had the ability to hire and not experience the kind of wage pressures that some of the smaller companies are. They've had a lot of tailwinds behind them. This is changing.
Did you say wage pressures?
They have not seen wage pressures. Yeah, to the extent there have been wage pressures, it's been felt by the smaller companies. Larger companies have not seen the same or any kind of pressure on wages. We think this is changing. We're not saying that it's time to go into small caps yet, but we think that more domestically oriented companies are going to have, in the United States, are going to benefit, and that is going to have some, bias towards small cap stocks eventually.
I would, if I could just add to that, M&A cycle. The M&A cycle is starting to finally pick up. Yeah. We hopefully will see less inversions and more domestic activity that usually benefits small caps. They're usually the target of takeover activity.